So everybody's joining on Zoom. Please wait just a minute here, and we'll get things set up for another edition of Get Think Tanked. For those of you who are sick of spaces, this is your alternative. My name is Michael Guide. I will be your co-host and moderator with my friends here at Toroso with special guest Darius Dale. I will try to bring some of you up. If I do, please have the bar background so that you can join us and make it just more fun in general. So as usual, I'll go around, have everybody introduce themselves. We will start off with Mr. Weisskopf. Tell everybody about yourself, please.
Sure, otherwise known as the ETF Professor. I am the lead ETF strategist for the ETF Think Tank and also co-portfolio manager of the blockchain fund BLOK. Thank you, Darius, for joining. I always like a guy who smiles a lot.
Yeah, me too.
A lot of that. Mr. Chikansky.
How's it going, everyone? David Chikansky. I am the portfolio manager of the SoFi Gig Economy ETF and the iWin Inflation Fighters ETF, along with Mike Venuto. Today should be a really awesome conversation.
Cynthia Murphy.
Hi, guys. I am the director of research for the think tank, and I'm on the content side, not on the PM side. And I love the weekly show, so thanks for joining us, everybody.
And of course, Mr. Venuto.
Hi, everybody. Excited to be here today. I'm thrilled to have Darius back. As I actually asked him to come back because of the new product we did with Amplify, the inflation fighting fund, iWin, because what 42 Macro has done with the grids and the way they look at inflation, it blew my mind when we had him on the first time, and then we had him on Spaces. So I thought if I was going to get to plug our new fund, we had to get him back over here. So that's it for the plugs. Let's talk about the logistics. This is a happy hour, right? This is something we built in response to all being locked up. I guess the world is reopening. I was in New York City yesterday. Now you have to get a bracelet to be in a bar, which is strange. They like this is like a steakhouse, and I have to wear a paper bracelet proving that I have a vaccine.
Just like Disney bracelet.
Yeah, it's kind of like a Disney bracelet. All in all, still was a good steak. Good people. So other logistics. We like to have a little drinking word. So when you come up to the bar, every time you hear impulse, we're going to have a sip together. It's a word we haven't used before. I'm excited about that one. And yeah, if you want to ask a question, put it in the chat and we'll try and get you promoted up here. The more people on the screen, the better. Help us retweet, help you get your background. Come have some fun with us. I don't know. Did I cover everything? I feel out of practice.
You did great. You did great.
Yeah, you got to transition. You got to transition to the special guest, Darius, for those who don't know.
Okay, you do that.
So in addition to, hi everyone, thanks for joining us. Appreciate being on with you. In addition to being the founder and CEO of 42 Macro, I also specialize as I dabble as a Sears and JCPenney catalog model. So that's what you're seeing up there. So some of my best work. Don't flip to the underwear section. You're not gonna like what you see. But anyway,
25% discount on his shirt at the end of the show if anyone wants it. So just hang on tight.
It'll be one of those episodes, folks.
Indeed, it will be. But sorry, having some camera issues here, so bear with us. But looking forward to a fun conversation.
All right, so Darius, I'll start off. So, given your grid approach and the threat of what seems to be a looming war, depending upon what day it is, how does war impact which part of the cycle you think we're in? Right, because when you look historically at periods of war, you tend to not have massive declines, but maybe this time is different given oil's movement. But talk us through sort of what you think here with Russia and Ukraine.
Oh, great question, Michael. So I think it has a lot to do with the government mobilization effort in and around the war, to the extent that they can move quickly enough and mobilize resources in the economy. It's very likely you get a sort of reflationary impulse, at least domestically, that's higher inflation, that's higher growth. The problem with any sort of mobilization effort from this particular juncture is that we're struggling we're struggling with the labor supply. I mean, if you look at JOLTS divided by total number of unemployed people, we're up at 1.7. That's almost a double relative to any previous cycle peak. You look at the labor force participation rate, not just the headline, but if you look at it across different cohorts, down 120 basis points from its cycle peak for prime working age individuals, 110 or 120 for senior citizens, 100 basis points for females. Like, it's a pretty broad-based reduction in labor supply. So if we were to go to war at this particular juncture and the government was an additional tax on the productive capacity of the economy, what's more likely to happen is that you get a stagflationary episode, and that's what we characterize as inflation. That's where growth slowing and inflation is accelerating.
And that we're with the question, we're presuming just Ukraine, right? But what happens if it's a double whammy next month and we've got an issue with China as well? What does that do for all your considerations and stats then?
I mean, let's all, I think if we have an issue with Russia and China, I don't think any of us would be thinking about our portfolios.
Let's throw it all in there. Let's say there's just World War. It starts, right?
Yeah, World War III, it's gonna be a lot of cash in the Darius Dale and by extension the 42 macro portfolio construction. We don't have a process for that, but what we do have a process for is understanding how critical macro variables impact exposure through the lens of expected returns, volatility, covariance, and percent positive and negative ratios. And what we're trying to do is understand what's the likely path for the economy, what's the likely path for monetary and fiscal policy, and ultimately, if something like that were to happen, it'd be pretty clear from our perspective what those things are, and they're not good.
I'm going to just jump in then, because it's funny. 2 or 3 weeks ago, we had Danielle DiMartino Booth on, and we got to this question about Ukraine and Russia and all that, and she threw out, what if they both go, right? What if Russia and China invade their Taiwan and Ukraine at the same time as soon as the Olympics are over? And man, that like
February 20th, right?
Yeah, February 20th. She scared the crap out of everybody. So I do, it always blows me away when you think about these processes of thinking of where the market's going to move to and how they can actually deal with exogenous black swan kind of things like this. And so I need you, I know you talked us through some of this the first time you were on, but how do you get to the signal in the noise when there could be some crazy giant signals that aren't in the noise right now? Just talk us through that process in your research.
Yeah, phenomenal question, Mike. So in our opinion, and again, this is our opinion, I'm just, a guy in a room with the side gig as a JCPenney catalog model. In our opinion, markets don't price in black swans. They price in the resulting impact of the black swan upon economic variables that are matter to markets, upon liquidity function in financial markets, and ultimately upon the reaction function of monetary and fiscal policymakers. Right? The black swan itself is not the issue; it's what happens to the economy that's the issue. Obviously, if we go to war with China and Russia, and we don't have enough labor supply to perpetuate a mobilization effort, we're going to stagflate ourselves into oblivion. And I would argue China and Russia are likely worse off in that regard. They're not exactly beacons of labor force participation growth or working age population growth either, from either perspective, or more importantly, from China's perspective. Again, I'm not personally informed, or I'm not particularly informed on these dynamics any more than reading what you guys are likely reading as well. But it strikes me that it would be particularly odd for President Xi to make such a drastic measure in a year where he's trying to sort of coronate himself as, kind of China's, second supreme leader on par with Mao, and, really lock in a third term as president, really a term for a lifetime. Invading Taiwan would be such a gamble. There's no guarantee that the U.S. is going to sit idly by, or that NATO is going to sit idly by, or more importantly, that sort of all of China's major trading partners are going to sit idly by and let that happen. So why would you create such a mess for yourself where there's no sort of guarantee for success into a national party Congress later this year, where you're trying to get so much accomplished domestically?
All right, so I put a poll out not too long ago, Darius, and the poll was, who stands to benefit the most from Russia entering Ukraine? And I had three options: Russia, Ukraine, and then I had the Federal Reserve. And I did. Sort of. And it was Russia was number one, obviously, and then the Fed was number two. So obviously it's a leading poll. But talk through what you think happens here with the Fed, because this is, I think, where the market is really quite nervous, right? Because if war ends up meaning that they delay rate hikes while inflation is still high, because they want to be extra cautious, then you could really have a situation where this really gets out of control conceivably as far as inflation goes. Yeah,
totally. So I'll give you three statistics that tell you that the answer that the Fed would enjoy this is, in my opinion, the wrong answer. I've already given you one. That's the JOLTS relative to unemployment or total unemployed people, up at 1.7. Again, that's just off the charts. We're not even close to any previous cycle peak. The next metric would be inflation itself, particularly the median inflation rate. We saw that number jump up to 7% on a seasonally adjusted annualized basis in the month of January. And that's the fastest rate of inflation on a median basis ever. This is the broadest inflation we've seen in the U.S. economy since going back to the early 80s. And so, clearly the Fed's got an inflation problem on its hands, and it has nothing to do with just headline or just core or whatever, however wonky they want to do it, or slice it and dice it. And then lastly, it's the employment cost index. We saw that number accelerate to 4% year over year in the fourth quarter. That's the fastest growth rate we've seen since the fourth quarter of 2001. So precisely 20 years, we haven't seen wage pressure in the U.S. economy, or we haven't seen it in 20 years. And so that tells you, in our opinion, one, the demand for labor; two, the amount of inflation in the economy; and three, the specter of a wage price spiral continuing to loom and be on a prospective risk. To me, that tells you that the Fed can't happily respond to any sort of tightening of financial conditions at all, let alone if they, who cares if they come from Russia invading Ukraine or China invading Taiwan. The reality is the Fed has a job to do, and it has a job to do to reestablish its credibility on the inflation fighting front, because we're at some pretty critical thresholds and well beyond some critical thresholds as it relates to the underlying inflation pressure, momentum, and ultimately the impulse drink in the economy.
Thanks for that. I mean, I got to. David's got the question, but I got to thank you for the impulse, and I got to thank you for making the investment case for our new iWin fund. So, go ahead, David.
Yeah. So, first question is: haven't you seen a slowdown in wage growth in the last couple of weeks, right? And isn't that kind of one of the things that could potentially push inflation towards stagflation? And then the other question I have for you is, how high can rates go this year? I personally don't believe that they can do more than 50 basis points, at least before midterm elections, without longer term rates moving up, which I just don't know how far they can move up. And they're just not going to hike into an inverted yield curve. So I think a lot of it is posturing from Putin, posturing from the Fed. It's just posturing all over the place. And I think that's the trade to play. But what are your thoughts on all of that?
Yeah, no. So that's a loaded question. So I'll start by saying, it's not, at least according to the data we track, we would disagree respectfully that wage pressure is abating. If you look at the most recent jobs report for the month of January, so taking it a step beyond where we saw from the employment cost index in Q4, average hourly earnings accelerated to 5.7% year over year. That's the fastest rate we've seen since May of 2020. And if you want to look at it on a sequential basis, that 9% seasonally adjusted annualized rate was the fastest rate we've seen since December of 2020. So from that perspective, there's no abatement in wage pressure. Maybe there's some higher frequency data, but again, we haven't proven these higher frequency data sets to be particularly reliable because most of them didn't exist prior to the pandemic. Secondarily, again, I would take the other side of the view that the Fed is afraid to hike into a flattening of the yield curve, and here's why. We got the January University of Michigan consumer confidence data point on Friday, last Friday. And then the headline came in at the lowest print we've seen since October of 2011. But to me, I think there's two statistics that really stood out in the print, that kind of, I think, would spook the Fed. One, obviously inflation expectations on a 1 year basis are still elevated. They accelerated to 5%. That's the fastest rate we've seen since July 2008. But I guess the other two statistics to me that are really important, I think, are probably very important to the Fed as well. Again, this is one survey. Let's not overly anchor on one survey, but I think it perfectly summarizes why they need to act and why they should not be afraid of a flattening of the yield curve. And the first of the last two is the current, the index for current financial conditions compared with a year ago that ticked down to 97 or crashed to 97. That's the lowest print we've seen since November of 2013. And then more importantly, the expected change in consumers' financial situations in 1 year's time, that number declined 13 points to 101. That's the lowest print we've seen since August 2011. And so what this data is telling you is that if the Fed doesn't do anything and continues to sit on its hands and let inflation continue to roil real incomes, we're probably headed for a recession anyway, right? So what's worse, a recession born out of a Fed losing its credibility or a recession born out of the Fed regaining its credibility? And to me, I think Jay Powell and the committee, the members on the FOMC committee would happily choose to set the latter over the former.
And just last on that, you think that's true even in a midterm election year where there is less and less separation between Fed and politics? Because that's what I keep wrapping my head around. I was just like, at some point they're going to get some pressure to just like start printing. It's not going to be from the people.
Yeah, no, David, I agree with you. They're going to get pressure to start printing. Again, let's start by saying the premise for what we're talking about now is that Russia invades Ukraine and China invades Taiwan. I'm not saying I have any edge on that, but for all intents and purposes, those are low probability events, at least according to today. Our view is that Putin is really forcing the West to come to the table on NATO's westward expansion. And he's using this opportunity, with the Olympics, kind of being in the eastern part of a lot of eyeballs being in the eastern part of the world, kind of to take advantage of his military might to get the West to the table. That to me, at least, according to some of the smart people I pay attention to, that seems to be the play. So it's let's say that it's a lower probability that we have a massive geopolitical sort of excursion this year than it is that we actually don't. So that takes me back to sort of the political risk in the U.S. The political risk in the U.S. I mean, I would argue the Fed I wouldn't say it is an apolitical body, but it certainly doesn't bend and break to political pressures. I mean, the political pressure that President Biden is putting on the Fed pales in comparison to the political pressure that President Trump put on Jay Powell specifically. I mean, called him out specifically, called him names on a regular basis. I think Jay Powell is a seasoned vet who can handle, anything that the White House is putting on him. To me, I think the biggest pressure on the Fed is from the financial markets and from the real economy that might actually have a real impulse or a real, you might as well drink anyway, that might have a real sort of issue with an inflation impulse that continues to be untamed. Again, I mentioned median CPI, the most important metric for us all to be focused on, accelerated to the fastest seasonally adjusted annualized rate it's ever recorded. The Fed's got to do something, and that's all the pressure it needs.
All right, so Darius, it sounds like you and I are of the same mindset that risk off is not here yet, which sounds a little strange because most people, when they think about risk off, they think about direction. And to me, it's more about behavior, right? When you have credit spreads widening, that's risk off. When you have treasuries significantly outperforming equities, that's risk off. When you have defensive sectors leading, that's risk off. It's not just about direction. And I've made this case many times that I think a bigger risk off period is still yet to come, right? Despite all this dislocation and pain we've seen so far. Mm-hmm. You sent me a DM saying you think there's going to be a summer swoon, right? So talk through this idea that we haven't maybe seen a real big decline yet, that something bigger might be coming. What's your thesis there?
Yeah, so I'll start by confirming what you're saying, which is we're not quite risk off yet. If you look at so we run a couple different processes. We sort of have three legs of a stool with respect to our investment process of 42 Macro. One, there's nowcasting what the markets are doing. So effectively, really quantifying exactly what grid regime the market is effectively pricing in on a modal outcome basis. Secondarily, we're sort of nowcasting and projecting and forecasting what grid regime the economy is likely to be in on a prospective basis. And then we sort of lay that on with qualitative analysis, looking at where we are in the broader, longer term cycles and things of that nature. So from a market regime nowcasting perspective, we are currently in what we call inflation. And that means the markets are pricing in a negative growth impulse with a positive inflation impulse. Historically, that's been risk off. But more importantly, there's one metric that we track in terms of how strong is this inflation market regime, right? So it's only in the 32nd percentile of all the data we have going back to January 1998, which means translation, it's a pretty weak risk off inflation regime. It's like where markets are pricing in stagflation, but not to an excessive amount, right? That number could obviously, double and triple. Number two, what are the economy doing? Well, the economy is very clearly, at least through the lens of a composite leading index time series, and obviously the inflation time series that we're in what we call inflation or stagflation, as most of you would term that. That's a negative growth impulse. That's a positive inflation impulse. And so part of the reason, in our opinion, that the markets are not yet fully ready to price in a more strong sort of inflation regime or stagflation regime in the markets is because it's very likely that inflation bottom up regime, that what the economy's doing, is likely to be either interrupted or sort of, kind of mitigated by what we've been terming in our research as this post-Omicron bounce dynamic. We saw, sort of prior to sort of yesterday's retail sales and industrial production data, which obviously were, flattered by seasonal adjustments and things of that nature. Most economic statistics, at least on the leading survey data side, for the month of January, we looked at the NFIB survey, the consumer confidence, the PMIs. They all been, pretty weak. It was indicative of, sort of a Omicron having a pretty material bounce or pretty material bite as it relates to the growth impulse, coming from Q4 to Q1. It's very likely that the sort of resolution of Omicron and its impact on the economy in terms of people calling out sick and stuff, it's very likely to be resolved positively into, so let's say February, March, April, who knows how long it might last, but certainly into the spring, you could see a positive impulse in growth. Now, it's unlikely, at least according to a lot of the qualitative analysis that we do, the third leg of the stool, that impulse is A, sustained, and B, very material. And that brings me to the sort of, kind of the last point I'll make on kind of the ultimate downside risk we see in the market as it relates to the pending risk off regime that we still see ahead of us. There's kind of three main, dynamics that we're thinking about as it relates to, to ultimately quantifying, downside in the markets. One is the positioning, lens. Two, there's the business cycle lens, and three, there's valuation. So I'll start with positioning. Kind of the best metric we use to track, how risky markets are, how much over positioning investors have towards, equity markets and risk assets by extension. We look at household equity ownership as a ratio to net worth, and that number is at 29%. Then that data is through the third quarter of this year. We get it from the flow of funds report. That's an all-time high. And what we know, it's coming off an all-time high. And there have been 16 cycle peaks in that metric since the 1940s, and there's been a median 28% S&P 500 drawdown since those cycle peaks, post those cycle peaks. So that's one. Number two, we got the conference board labor differential. So just trying to quantify where we are in the business cycle. So this spread between the conference board's jobs are plentiful in 6 months' time index relative to the jobs less plentiful. That number stalled out around 43, 44, kind of 6 months ago. We've been started tracking sideways at a cycle high. That's the second highest print we've seen in that time series. There have been 9 cycle peaks in that time series since the 1960s, with a median S&P 500 drawdown from hints of 36%. So we've got minus 28%, minus 36%. And then lastly, we have the valuation. The real S&P 500 earnings yield. This chart's been making the rounds on Twitter for 6 to 9 months now. And we hit an all-time low in that metric of minus 3.2% in January. There have been 7 sub-zero readings, where the real earnings yield, or where the nominal earnings yield was less than the rate of inflation since the early 1960s. And the median S&P 500 drawdown from each of those sub-zero readings is minus 34%. So minus 28, minus 36, minus 34. Now, again, it doesn't all have to happen in this summer or this fall or even in 2022, but that just kind of tells you the sort of setup we have with respect to a Fed that's sort of being forced to tighten, if only because it's forward guided itself into that scenario. Whereas the growth impulse, the inflation impulse, and ultimately sort of where we are with respect to the positioning, the business cycle, and valuation cycles all tell you that there's a pretty big risk off period ahead of us.
You covered a lot there. So listen,
I tend to do that.
I took the 4 charts that you gave me and I put them in the chat. I'm going to do something a little different here, Guy, because I'm getting a lot of complaints that people can't see Darius. So like, because his camera's off, the people that aren't up as panelists can't see it. So I'm going to do the share screen thing if you enable, and let's put his charts up and let's talk through some of them. And then let's get Don up here. Don's got a few questions. So let's do the chart run through and give people something to see as he's describing it. You can't enable me?
Yeah, I'm trying to see how to do that. Sorry, everybody.
Yeah, I'm throwing a curveball at you since
I'll make you a host here. Let's try that.
okay.
He's good at curveballs today.
How's that?
Well, I mean, the good news is everybody thinks your smile is exquisite.
Oh man,
Better than atrocious.
All right. Can you see this chart? I think this is a good one to start with, because I think this one really is, the graphic of what you were just describing. So why don't you take us through this, and then we can look at any of the other ones you wanted, and then we'll get Don up here.
Absolutely. So if you allow me kind of 20 seconds to geek out on how we get to these metrics. So we run this process called our global macro risk matrix. It looks at 42 different macro market indicators through 12 different asset classes, whether it be forward inflation swaps or copper, WTI, Bitcoin. Again, it's every market, touches every market, and we score it through the lens of what we call our volatility adjusted momentum signal. So it could be bullish, neutral, bearish. And based on the behavior of that particular exposure relative to each of these 4 grid regimes historically, we sort of tag its current behavior relative to that historical behavior. So let's, for instance, if the S&P 500 is bullish, we know that S&P 500 has to be pricing in either Goldilocks or reflation. It's probably not pricing in inflation or deflation, because historically the S&P has been bearish. And so we run that iterative process across all of the 42 indicators in that model. And so what we're ultimately trying to determine is what is the grid regime that has the sort of highest percentage of markets in that model, sort of confirming it at any one particular time. And so as you can see, really since the second half of last year, really I would argue that the June FOMC event was the most important catalyst, really since going back to probably the Fed's response to the pandemic, initial response to the pandemic, because that was the first time after what had been a sort of what it felt like a sea change towards MMT, that the Fed came out and said something different. And ever since they said something different, we've been oscillating back and forth between inflation, which is stagflation for most of you listening, and reflation. We had, again, that big post-Delta bounce in October that caused that reflation, had a little bit of reflation towards the end of the year as investors started to reposition in value and things of that nature. But generally speaking, we've been oscillating, and there's been a lot of volatility in this nowcasting process. The last time, as you can see on the chart, the last time we had this kind of volatility was in the summer of 2018. In the summer of 2018, ultimately gave way to the crash in Q4 18, which we called back in my prior shop. Made a very good call on that. And so my point is the market is very clearly telling you that there's a divergence going on. One, there's a divergence between the forward outlook for things like growth and inflation relative to the current liquidity dynamic, right? The market is concerned. It wants to go down, but at least up until February, up until this month, the Fed was still doing QE. So this, we're having this schizophrenic fight between deteriorating fundamentals and positive liquidity dynamics. Well, guess what? 2 months from now, we're not going to have this fight between positive or deteriorating fundamentals and positive liquidity dynamics. 2 or 3 months from now, we're going to have deteriorating fundamentals and deteriorating liquidity dynamics. And that to me is a big issue in terms of why we think a lot of market risk could start to catalyze itself. Let's call it around May, June, July of this year.
All right. Is there any of these other charts that you want to cover before we go to Don and then Dan? I know, Dan, you got your hand up too, but we told Don we'd go first.
Oh, no, we're good. Let's get some questions. All
right. Go ahead, Don.
You guys hear me?
Yes, sir.
Awesome. So
we appreciate you having the background going too.
I made sure to get it done. So my question is, and kind of the backdrop is, as you as investors, we can purchase essentially foreign securities let's say through an international ETF or directly or things of that nature. So if there is an actual, let's say, kinetic war, right? Does like what happens in that case? Like, what if they just shut off all foreign investments into Russia or China? Like, what happens with the plumbing in that system?
So I'll start by saying, if there's a kinetic war, put 100% of your assets either in cash or crude oil. If you're joking around with other things, you're probably going to lose money. Again, we're talking about the world's 3 largest superpowers as it relates to military might. We should not be trying to game a kinetic war between the 3 of them. We should be fearing for our lives and the livelihoods and the lives and livelihoods of our loved ones. This is not an investment discussion. If China and U.S. and Russia go to war, the financial markets cease to exist. It's about surviving as a human being. So I'll start there, and I'll end where I started, which is, again, your investment universe will dwindle and shrink to a very narrow subset of things that are designed to do well when all hell is breaking loose. And one of them is cash, and the other one is probably crude oil.
It's funny because there's always that disclosure and perspecti about country specific risk, which is really kind of what you're hitting on, Don. For whatever it's worth, I think. Look, all this is like mutually assured destruction at a certain point in the argument, right? So okay, so China ends up delisting or cuts itself off, or Russia cuts itself off. Listen, all this stuff is going to be very damaging to them and to us. So I think it's a hard thing to kind of really position for in the extreme.
Michael, you hit the nail on the head. It's not even mutually assured destruction in the traditional sense. I took a Cold War with John Gaddis when I was in college, and he's the preeminent authority on that. And I think he would, if he's still alive, but he would tell you today that it's more about mutually assured political destruction. So I think it's a step further than economic destruction. Now it's more about what economic destruction might mean to these people running these countries. Don't forget, Xi's stranglehold on power only exists because you've gotten, I don't know what the numbers are, but you transformed a very large chunk of formerly very poor rural Chinese citizens to being, middle class people in cities. And that's been a very powerful thing for him over the last 10 years or so. Russia or Vladimir Putin's power, I would imagine, has probably done something similar in terms of he's either killing a bunch of people and scaring the hell out of people, or he's done something similar, or both, right?
Well,
and so
poor impulse control.
And
Poor
trading
impulse
fixed
control.
jars.
Exactly, that guy, yeah, totally, that guy. So anyway, so my point is that it's not just about these guys are unwilling to do certain things because they know that we have missiles too, and we have tanks too, and submarines too. It's more that if this really goes awry, it's hard for them to maintain the leadership. And ultimately, these are strong men. These are powerful people who thrive and really ultimately get off on being the leader, being in charge. And so we have to understand that dynamic as well, because they're still human beings.
All right, Professor, you're up.
Yeah, I'm vacillating between 2 or 3 questions.
I'm going to drink because you said vacillating.
That's close enough to impulse.
Okay.
So here, you pick one. Then Cynthia, you can go next, and we'll go back to Don because I know he's got a second one.
Okay. So my one question, because I'm limited, is given this isn't a pitch for Block, and it's not a pitch for Bitcoin, but we haven't had a recession in the existence of Bitcoin. So how do you know how to fit it into your models? I haven't had inflation for that matter either, but yeah.
So recession is a wonky academic term, right? That has little to do with how you want to be managing macro risk ultimately. How we fit these sort of dynamics, these impulses into our models is through the lens of the direction of travel for things like growth and inflation, the magnitude of the change for things like growth and inflation. So when we categorize a recession, we don't say, hey, the U.S. economy was in this thing that only happens like once every 5 to 7 years. And in terms of our back testing and ultimately studying and understanding the, again, expected returns, percent positive ratio, volatility and covariance of assets, we categorize it and say, hey, look, the economy had a -2 sigma delta in terms of its growth impulse, i.e. it slowed really fast relative to its trend. that to me is more important to quantify than sort of than characterize as a recession, because ultimately you don't need a recession for asset markets to crash. We've seen this several times in the QE era alone, right? You go back to Q4 18, you go back to 2011. You don't need a recession for markets to crash. What you need is a sharp deceleration in growth. More importantly, you need a sharp deceleration in growth that is aided and abetted by a tightening of monetary and fiscal policy, which, if you look at our models, it kind of seems like that's something that could occur in the back half of this year.
My friend David Deerking texted me saying he's long bomb shelters because of this conversation.
Just buy bonds. Fuck it. Sorry.
Well, but hold on. Let's put a little bit more of an optimistic spin, right? Just to balance out. I mean, I think we all know what the optimistic scenario is. There is no war. The Fed gets it right, and all the areas, which includes the archetype names, all the areas which have sucked wind since February, they rebound. Right? They have a big run underneath the surface. This kind of breadth bear market ends. What else could be positive signs besides those? Those are obvious, right? But what could surprise on the upside, you think?
Yeah, so I'm going to throw another chart in the chat, just make sure everyone has it. But so to positive, we are not yet at the point in the cycle where we should be concerned about a -2 sigma delta deceleration in growth, or what other people would call a recession from a qualitative perspective. Like, those are the kinds of things that really get market spooked. Quantitative tightening is obviously one of those things that really get market spooked. We're not quite there yet. And so, as I mentioned at the outset of the discussion, it's very likely that the next impulse on growth is positive. We had a negative impulse on growth starting in kind of November, really starting in December and spilling over into January, at least through most of the January data that we received. It's, sans yesterday's IP and retail sales data. That negative growth impulse took us well below the trend rate of deceleration, and we should ultimately rebound back towards that trend rate of deceleration, right? If you think about it like a negatively sloped curve with a couple of U's attached to it, right? And so we're in the second U. The first U was Delta. The second U was Omicron, and so that's positive, right? And this chart I just put in the chat, Dan or Mike, or if you guys can grab that and put it up there. The chart I put in the chat, it just shows sort of, the chart on the left shows what we call our crowding analysis, and what we're trying to do is identify extremes in derivatives, in the derivative space, to ultimately bet against, right? To position to take the other side of. And right now, there's an extreme in the derivative space in what we would classify as high beta cyclicals, or the types of assets that would do well in a reflation trade. And so, the market is set up for those things to really rip into the spring should Russia not invade Ukraine, and we just get this post-Omicron impulse, positive impulse in growth in the United States and really around the world. Number two, the chart on the right in that chart just popped in the chat shows what we call our dispersion analysis, and what that analysis is designed to do is monitor changes in the composition of the upper quintile of sector and style factor leadership, not from a performance perspective, but really from a flows perspective, relative to the lower quintile of sector and style factor leadership. And again, we track about 60 U.S. equity sectors and style factors on a daily basis in this analysis. And right now, that analysis is telling you that, again, what really moves the needle in terms of flows are all the pod shops. These are the multi-manager platform shops, the Citadels, the Millenniums, .72s, Balyasnys of the world. These are the guys who control 70, 80% of market turnover every day. And quite often, these are the best stock pickers, credit pickers in the world. And I make no bones about that. Most of the people I think are the best stock pickers and credit pickers work at these firms. They've been rotating pro-cyclically. And pretty consistently pro-cyclically since the end of December. And so that's telling you that there's this sort of, at the bare minimum, from a microeconomic standpoint, talking about earnings now, there's still this sort of positive earnings dynamic that we still see ahead of us, that these investors are all hot and bothered by. But again, as we get further into the year, when we return back to that trend of deceleration, and ultimately we start to slow at a faster pace, that slope starts to get more negative, that's when it's more likely we'll start to see dispersion flip back from to defensive. We'll start to see bond yields really going down. We'll start to see stocks, picking up in their volatility. We'll start to see credit spreads really starting to blow out. Because again, one of my core theses of this year is that we're going to have a growth scare while the Fed looks like it's on autopilot from a tightening standpoint. And few things are as adverse to markets as that setup.
Wow.
And Cynthia, I thought you had a question earlier. I don't know if you want to come in.
Yeah, I was just gonna go back a little bit in you were talking at the very beginning about median CPI being a key metric here to look at. If you are just a self-directed investor and you're out there trying to make sense of this huge mess of everything that's going on at the same time, you can't model the unexpected. You can only deal with the expected and what you know, but what you know, there's so many different metrics and then so many different opinions. And, are we going to deflation, hyperinflation, inflation, stagflation? It just, I can't imagine actually, where do you start? So I was just wondering, if you are out there doing this yourself, and let's say you have a full-time job, so you're not just watching the markets and reading market analysis all day, what would you say are the key metrics to, really be your guidepost from here on out, at least on a short-term kind of tactical basis, so that you're not just overwhelmed by so much that can go right or can go wrong, from access to stories, to war, to all that's going on?
Yeah, no, Cynthia, that's a phenomenal question. So I'll start by saying if you're not doing this full time, you're at a significant disadvantage to the people like us who are doing this full time. So the expectation that you're going to outperform somehow, one, let alone generate that positive absolute returns, but let alone try to or even try to outperform, in my opinion, is both preposterous and disrespectful. There's a lot of really, really smart people working on global Wall Street that get stuff wrong all the time, including myself. And so if you're a retail investor and you think you can do this for 1 hour or 2 hours a day and actually have good success, to me, I think you're smoking something. And there are times where that actually makes sense. Like when there are times, you go back to 2009 and into 2010, or coming off of 2012 into 2013, or 2017 into 2018, where you could literally like throw a dart in a dark room full of people and still hit a bullseye. And the volatility is collapsing, and it's because we're in the right place in the economic cycle, from a growth and inflation impulse perspective, for markets to trend higher and for volatility to trend lower. This is not one of those times. One of those times, the most recent iteration of one of those times, is coming off of the crash and collapse in COVID. Really, since starting in the spring of 2020, we were in one of those times from the spring of 2020 through June of 2021. And since basically July of 2021, we've been in one of those times where we do not have trending sector, style, factor, index leadership. Nothing is really trending. And if anything, we're just accumulating volatility, realized volatility, and we're accumulating widening of risk premia. And that is not the economic environment where it pays to be a retail investor. I'm certainly not marketing my service or any other service, but I would certainly highly recommend that any retail investor in this particular environment go find sources that they trust. Because trust to me is the critical variable, because everybody's going to get something wrong. But do you trust that someone has a good enough process to recover from mistakes, and more importantly, learn from those mistakes? Go find smart people that you trust that can help you navigate a higher volatility regime, a regime where all the tailwinds aren't at your backs. We made a historic call going back to late October, late October in 2020. We said, hey, there are 5 things that are about to happen that almost never happen simultaneously. The growth impulse will be positive. The inflation impulse will be positive. The monetary easing will be, basically as aggressive as we've ever seen it. Fiscal policy will be easing materially, and corporate profit growth and more importantly, operating margins are going to be expanding. You put those 5 things together, they almost never. There's been 10 quarters since 1960 where those things have happened at the same time, and 3 of them occurred between Q4 of 2020 and Q2 of 2021. 3 of the 10 since 1960. And so that was such a positive, forceful environment to just really pig out on beta and really take as much risk as you possibly can. That's why we saw the proliferation of altcoins and things of that nature. This is more or less the opposite of that. Again, I mentioned we got to get through this positive growth impulse in the spring, but once we get into the summertime, all of those things I just said will be working in reverse. And so as a market participant, at the bare minimum, your modal outcome, your base case scenario should be the market should do the opposite of what they did from October 2020 through June of 2021.
Yeah.
Sorry, that was a long-winded response. My apologies.
Yeah, no, it feels because you hear then that's when you start to hear the, best way to do it is just stay diversified, stay the course, maybe look at inflation fighters as an addition there and try to navigate to that space. But in truth is a tough one because the whole, put to cash, but then you're losing 7.5% of that right away. If you're not into that short-term tactical play, staying the course doesn't look like it's going to work either. It just is a really tough environment for having to face it alone, for sure.
Yeah, well, I would argue, Cynthia, you kind of alluded to something that I think is important to remind investors of. When you have elevated above target inflation and the Fed's doing something about it, most assets should be going down in price. That's what the Fed tightening policy is trying to do. It's trying to widen risk premium and tighten financial conditions. So by definition, there shouldn't be that many places to go run and hide. I mean, that's what the Fed, again, that's how you kill demand in the economy is by making it harder for consumers and businesses to borrow. And the only way you can do that is by widening risk premium. And so, again, that's sort of the age-old kind of attitude, the age-old dilemma. Do I take a 7.5% loss if we sit here at the same rate of inflation, of which we would argue we're not going to? Our models would suggest we'll be back around 4% in a year's time. But do I take a 4% loss from here, or do I take a 20 to 30% loss in my equity portfolio if I'm wrong wrong kind of stocks, or do I take a 50, 60% drawdown if I'm long crypto? That to me is a no-brainer trade.
Poor Cynthia, because Cynthia's, I think, coming from the vantage point, Cynthia, forgive me if I'm speaking for you, of somebody who does a lot of buy and holding, right? And now she's thrown into the tank here, and we're having these scary ass conversations. I hope the key part is that you won't change your strategy so you don't know where you are. I think that's always like a critical component for anybody, right? They got to know who they are. They got to know how they manage their journey, because at the end of the day, the way I look at it is, it's easy to make a buy decision, right? Because you're optimistic, right? Otherwise you wouldn't buy. Then if you want to sell that position, well, now you're if you're not process driven, you're making an impulse decision. And then you got to make another impulse decision to know when to get in again.
Yeah,
sneaky Dan.
I know, Dan, you get a question in here, but I kind of want to echo what you were saying. Like when Darius was talking about having people who do this professionally. Look, I see questions in the chat about how do I learn to do this, or if I'm a retailer, this and that, and I want to learn. I mean, here's the real answer: buy and hold does work if you hold long enough.
No, and hold on, but even that's a little caveat, because buy and hold where? Right? Well, buy and hold with Japan hasn't really worked. Right? That's also a little nuanced too.
Well, but
I would make that point. Like I do think people take that for granted too. Buy and hold.
Yeah. All right. So overly diversified buy and hold.
Better way to say it.
Works over time. And when I say overly diversified, that includes commodities, that includes like all kinds of things, right? I think.
Well, you know why, Mike? We have population growth and declining interest rates. It should work.
Yeah, it should work. Yeah, right. Like it's honestly, it's just math.
Yeah, it's just math. Yeah.
But all this other stuff that all of us kind of get involved in, this is full-time job, and you're lucky to be right. 51% of the time, which is
51%.
That's all you need, and yet it's better than every baseball player. So, Dan, you want to get in there? I know you got a question. I just wanted to echo that.
No, it was actually more of an observation than anything else. Sorry, no question.
All right. Well, Don, did you have one more? Did we get you back in? I got pulled out for a second there.
Yeah, my question actually is very much related to what you guys have been talking about, which is, either Darius or anybody else who chimes in, like, is your entire portfolio tactically allocated, or do you have like a segment that's like passive, fully diversified buy and hold that you don't touch, and then another portion that is actively managed? And on that note, like for, let's say, retail investors, would you recommend the same thing? So what do you do, and what would you recommend?
We might need to roundtable this one. Why don't we
Yeah, I
make this
think
one
there's a
our
lot of-
roundtable?
That should be a round table. Yeah. So I'll go first because you guys will have awesome, really thoughts as well here. I'll start by saying, and I think most of the panelists would agree with me, there's no right way to skin the cat as it relates to portfolio construction, or at least the bare minimum. A lot of the academic research out there is inconclusive, right? There's certain things that work in certain environments and other things that work in other environments. I think as Michael's quote in the chat here, sticking to your strategy is more important than the strategy itself, right? Understanding the risks and limitations of your strategies is equally important as well. And so our strategy, we understand that we put a lot of onus on our ability to forecast what grid regime the economy is going to be in, either Goldilocks, reflation, inflation, or deflation. And we ultimately understand that there's a probability distribution associated with achieving or realizing any one of those grid regimes. And so our portfolio at any given time, my portfolio reflects the portfolio construction we sell to our subscribers at 42 Macro. It's based on the probabilities of achieving those grid regimes over the medium term. And so right now, it's a pretty flat distribution. 6 months from now, it'll be pretty not flat distribution. It'll be pretty, there'll be a lot of excess kurtosis around the deflation regime, to say what I mean, to say the least. And so you'll see a lot more deflation bets in the portfolio. But the reality is, at the end of the day, what we're trying to do is help investors, retail investors specifically, because institutional investors understand this, is get away from this concept that your portfolio is a singular bet. It's I'm bullish or I'm bearish, or I like all this stuff or I hate all this stuff. Your portfolio should be a reflection of a distribution of likely outcomes to varying degrees. And more importantly, your portfolio should be a reflection of a distribution of outcomes over varying time horizons. Right now, we're long things that I fully expect to crash later this year because we don't think it's time for the crash. We think it's time for the positive growth impulse in terms of the post-Omicron bounce in economic activity. So we got it parsed out in both grid regime probabilities, but also in terms of time horizons as well.
All right, so I'm going to chime in because I want to add to this, right? So to me, the most important thing with building a portfolio is knowing what your point of view is. And it used to be our tagline here at Tarosa. I think I still have it trademarked, but nobody else seemed to care. So, but what I mean, though,
A different point of view. That's the song I wrote.
Yeah. The real point, though, is like, take somebody like me. The bulk of my wealth is tied up in this company. So really, the investments that I would have really shouldn't be what I would be more investments in the stock market, because my entire wealth is tied to what happens with Block, what happens with Roro, what happens with iWin, what happens with all these things that we have. So that's one part to everybody needs to remember. It's, you hear these people who come out and say, I made all my wealth here or there. Wealth is made with concentration. Concentration, though, is not a long-term good investment strategy because eventually it blows up.
Right. Bankruptcy is also made with concentration.
Yeah, bankruptcy is also made, right. So like I can see right on the screen. There's two of the advisors on our team are here, Jim Hoffheimer and Jim Carroll. When we bring people to our investment strategies, we start with how much money do you need no matter what, and then we put that in the ultra diversified kind of permanent portfolio strategy, and then everything else can be thought about as income or speculation growth, things like that. And then our tactical things, like the stuff that Gaiad does, they're put into those strategies, but in the ETF wrapper where it's tax efficient. So it's all building blocks for us. So I just wanted to give that kind of concept because I feel like the last 2 years have made everybody think that you can come in and game this system. Honestly, the way to win is to recognize that it can't be gamed and just be along for the ride. You learn things at the edges. I've been saying a lot of that buy and learn, especially with crypto. Like I did O'Leary's thing today and I was like, buy and learn. He just said, buy everything. So it is what it is.
Cash flow, right? That's all he said. Cash flow.
Cash flow.
Yeah, money. Yeah. So my answer actually is more concentrated, and I'll speak to management teams and get a maybe false sense of confidence in what I own. Emphasize false sense, but at least then when I'm down, I understand why I'm down because things haven't worked out. It's a pricing mechanism. And now having said that, I lose sleep because of volatility. So it's all about your own human behavior would be part of my answer.
You look good for someone who hasn't slept, by the way, for the last several weeks.
No, but I think you said something really good there, though. Like, honestly, the drinking word, impulse control, is like one of the most important things in investing, right? Like, being able not to react is super, super powerful. At my old firm, they used to call it intelligent inactivity. Guess what? The clients hated that term, so I don't use it. But like, I think it's a good statement.
It's also more respond than react, right? Like one thing that Mike and I always talk about is like, if you don't know what your plan is, if the market falls 30% or rips up 40% before it occurs, and you're trying to create that plan once it occurs, like back to Darius's previous point where it's like, you can't do this part-time, jump in, research what you want to buy at that time, get the good execution, make that decision, and then be like, man, I just gamed the market, right? So my advice to you is like, have an overall path and be able to move in bands up and down based on whatever indicators you want to follow. But like, they all laugh at me for I'm the rebalance king, but all that really does is like, when things go up really high, you start trimming them and you systematically buy things that went down, right? Yeah. Like, so if you're going to do anything, like try to figure out a system that allows you to do that in some way without emotion, especially in these extreme moments, either up or down.
David's the only person who actually buys low and sells high, and it really goes in reverse for David. He sells high. If something goes up, he sells it. Something goes down, he buys more of it. He always knows, or, we meet every Monday and decide, if this scenario happens, what are we going to do in this strategy? And if this scenario happens, that respond versus react is super important, because if you're trying to make the decision in crisis, you will have your impulses and emotions change things. So Eric, I love the cat there, man.
I got
Cynthia, you got any you want to add?
Yeah, and I'll use kind of my standard tweets, right? If you can't hold an investment that's down 20%, you shouldn't be an investor. Number one, and you have to be aware of the time frame. It is remarkable to me how people, and I'm sure Darius, you see a lot of this. People will outline this really elegant argument for why a particular stock will do well. They buy, they talk about annualized returns, and then they sell a month later.
Yeah.
Like the time frame thing is really irks me to no end, the way that people view risk. The risk is you being in a drawdown when you need the capital the most. Mm-hmm. That's the risk. It's not the fear of getting agita from looking at your statement or looking at your brokerage account, right? It's pulling out money in the drawdown. So if you don't have to pull that money out, if nothing's changed, stick to it.
Mm-hmm. Yeah, 100%. I would add, I've always been one of those, I'm super hands-off, buy on the market and just ride it for the really, really long term. Like, I don't want to touch anything until I'm retired. But I gotta say, like in classic human behavior, for the first time this year, I'm like, maybe I need to be a little more hands-on. Do I need to rethink this? So I'm having doubts this year about the way I've done it all these years. So
it's spending too much time with us, Cynthia.
Yeah, impulse control, Cynthia.
Yeah, so maybe I blame it on you guys. But the truth is, I've slept great all these years. So I don't know that I want to give that up in order to be more tactically smart. But you can't help with all these conversations we have all the time to think that I'm probably doing something wrong by just letting you write it out.
No, I don't think so.
I don't think so.
Yeah, let me wrap some things up here for a nice little bow. First, everybody check out Darius's stuff. 42 Macro. I put the website in there. I'm sure we'll have him back. We've also have a deal with him where for advisors that want to work with us in the ETF Think Tank, we'll sponsor you getting access to his paid research and stuff like that. So reach out to Weisskopf or Guyad and we'll get you all set up. Next week, we have John Elder and Rob Emmerich on, data scientists that turned into a product that's in our trust that uses kind of a core US equity exposure with a VIX overlay. So it's another cool one that we'll talk through. In terms of another radical transparency idea, and I think it's sometime in March, we're going to have on Stephen Sykes, the COO of Public. So I took my personal account and put it on this website Public now. So anytime I buy something or sell something, the entire world can see it. I love this idea as a portfolio manager. I've mentioned it a couple times before. If Kathy is radical transparency with her, well, you can see what I'm doing in Block or iWin. Now you can see also what I'm doing with my personal account. And Cynthia, if you go there, you'll see I have never sold anything. So now why? Because I have Guyad's funds there. He buys and sells and does it tax efficiently. So why am I going to do it? Right? Like when I do it, I got to pay taxes. So that's kind of, I think, all the logistics. Darius will give you the last words and we'll wrap up here.
Yeah, I'll be brief. So Cynthia is absolutely right. The best strategy for 99% of the people on this chat in this discussion should be buy and hold. Don't look at your portfolio. Just ride it out. The problem is that 100% of the people on this chat are human beings, and we're subject to cognitive behavioral biases. We are subject to myopic loss aversion. Go read Thinking Fast and Slow by Danny Kahneman and Amos Tversky. They'll tell you all about it. And so the reality is when shit hits the fan, we feel the need to act and we feel the need to protect our nest egg and our capital because, right, what is your capital? What is your nest egg? It's the sum of all the money you've earned over a long period of time. And you don't want that long period of time that you will never get back to eviscerate, to deteriorate, to go away. And so that's where that fear comes in. So the reality is, as human beings with behavioral cognitive biases, we're going to make more investment decisions than most of us should make over the course of our lifetime. So that puts the onus on what is the quality of those investment decisions, that those excess decisions that we're making. Again, I think firms like ours do a good job or a good enough job helping people make better quality decisions. Obviously, the ETFs that you guys provide, particularly the actively managed ETFs, really help investors not only make better quality decisions, but not actually have to touch anything when shit's in the fan. That's really helpful. But at the end of the day, it's about the quality of the excess decisions you make because you're going to make excess decisions.
Awesome. Dan, thanks for reminding me. I put my hand down.
Yeah, exactly.
I think that's it, everyone. Have a wonderful day, and we'll see you next week.
Thanks, everyone.
Thanks, Darius.
Thanks,
y'all.
Darius.
Bye, everybody.
All right.
Be healthy and wealthy.
At least healthy.